Hey guys, so welcome back to my YouTube channel. It's been a while. I've been busy building stuff, thinking, and also trading personally. And recently, I've been receiving a bunch of emails relating to the hedging strategy and asking for updates, which is nice since I didn't know that there's a lot of interest related to the same. Um, but also in line with that, I saw it fit that I should actually make a video on an update on what I've been working on in as far as hedging is concerned, potentially whether I'm still hedging or moved on. And for instance, if there's any reason why I'm not hedging anymore, or I am hedging at the moment, um, I can give it, and then maybe we can walk through that. So this isn't really a super edited or planned video. I've actually just completed answering a bunch of emails relating to the same, and I decided, what the heck, let me just make the video and get the information out there so that we could all be on the same page. So for those who might not be aware about the hedging strategy that um, it's a very specific strategy that essentially, instead of placing stop losses to your trades, you instead use an opposing order that's equally sized to the one that you're currently in. So if I can give an example, I hope this will be a good example that you'll all understand. So for those who already know the hedging strategy I'm talking about, you can just jump. I think I'll add a timestamp below so that you can jump to the next section whereby I actually stop explaining. But yeah, let me just jump in. So assuming I have a buy order for one lot and I bought at this level, let's say this is 1.02. I'm just using random pricing so as to make it easier to explain. And if I wanted to set like a 20 pip stop loss, it would be at 1.200. So as you can see, this is a 20. I could have placed a 20 pip stop loss on the buy trade, but then instead of that, I hedge it. So instead of the stop loss, I place a sell trade, or rather a sell stop trade, since it's a pending order at the stop loss level where I could have set the stop loss. So I cancel the stop loss here and then just set the opposing order. And then if I get triggered on this trade, I hold it up until such a time I can close a good percentage of this trade. There comes a time where you can close a percentage of this trade, keeping some of the profits that you've just gained, and then using the rest of the profits to essentially close out part of this trade. As an example, let's assume that you waited for 40 pips. 40 pips. At 40 pips, this trade would be sitting on a profit of $400 if it's Euro USD. Basically, any currency pair whereby 1 pip at one lot should be equivalent to $10 per pip. So any currency pair that has that pip value should be aligned with these numbers. So without factoring in spreads and commissions, this is the math that you'd be dealing with. So you'd be having like $400 in profit, and then this trade, since it will be 60 pips off, would be sitting at around $600 negative in loss. So essentially, at this point, you could use part of these profits to close out, basically the profits from this trade to close out the loss from the opposing trade. How that math would look, assuming I'd want to keep $100 of this in my pocket. So like, remember, at this point, if you know how your account works, you have equity and then you have balance. Balance is the actual amount in your account. Equity is the amount your account would be reading if you were to close all your pending orders. So for now, if we can assume that you have a 10k account, 10k USD account, you would be seeing the equity would be reading 400 plus minus 200, so your equity would be at 98, of course not factoring in swaps or commissions, and your balance would be reading 10k. I hope we are at this on the same page at that. So when I say keeping an amount of the profit, and we decide, let's say this is $100, the moment we perform the action that I want to show you, our balance would be reading 100, and then our equity would be slightly less than that. Let me show you. So assuming you want to keep $100 of this, so I say keep $100, and then the rest we say that this is applying seems like I can't spell today. We apply $300. So we use $300 to close part of this trade. So if we close $300 of the $600 loss, we'll be closing a half. If you can remember your math, we'll be closing a half. So this half would be half of the volume. So if at this exact moment, the 40 pips, we close half of that lot size, we would remain with a trade of 0.5 lots. We'll have taken an immediate loss of $300, but then our balance will be increasing by $100. So the remaining equity would be down by about 0.5 times 60 pips, or rather 600 ticks in this case. So you'd find that our balance would now read 10,100, but our equity would be about, let's see, so 10,100 plus 400 minus 300. But then remember, we still have a pending trade that has a negative balance of $300 right now. 300, which is 0.5 times 600, 60 pips. So it'll be 300. So our equity will now read 97. I hope this makes sense. So, and then after this, once you've closed this trade, you set a pending sell stop of 0.5 lots. And then, as you would expect, the market would continue. Now I want to clear this screen and then continue with that example and expound on what happens next. So remember, we now have a buy trade of 0.5 at this level. We have a sell stop of 0.5, which is 80 pips away. But our price is currently at 60 pips away from this and 20 pips away from this one. If our price begins to reverse at this point, we trail this order, we bring it up and keep a distance of maybe 20 pips, but you can decide whichever distance you prefer, you can decide, of 20 pips. So in my case, I'll just use 20 pips. So we continue trailing it, continue trailing the order. Let's say it comes back to around 30 pips and then it triggers us. So it triggers our sell of 0.5 with a new distance of 30 pips. This is half of the initial loss that we had of 60 pips. So technically, we are now sitting at, remember our equity was reading 97 and our balance was reading 10,100. So right now, our equity will have increased by half of 300, which will imply it will be at about 97 plus 150, 98.50. So our equity will now have increased to 98.50. Remember, we still have a loss, but now we've technically reduced our loss because we had a loss of 300 pending. Now we've reduced it. So this is the best case scenario, of you actually getting a better selling price, a better price to sell at, and then you continue trimming down your buy. If the market never triggers your sell and goes into profit of the buy order, you can close the buy order at a profit. Assuming you close it at a profit of $10, you'd now have a balance of 10,100 and an equity of 110. I hope that actually makes sense. So this is the best case scenario. Now, back to hedging in general. If you understood that, I really hope that you understood that. If you didn't, I could make another video that, or rather give more examples. But essentially, what I noticed is that the best case scenario rarely happens. It rarely happens, especially if you don't have a strategy that has a very high win rate. The best case scenario rarely happens. So the worst case scenario is what I was trying to resolve by coming up with different solutions for working around hedges. So for instance, deciding when to hedge as opposed to setting fixed pip sizes. Instead of using fixed pip sizes, you would use the structure. So in this case, if the market was moving like this and you bought here, you'd only place your pending sell over here, since you're expecting, or at least expecting, that there's a higher likelihood of the market to be in a sell, to enter a sell regime once it gets to this point, as opposed to you placing it, let's say 20 pips away. It triggers you and then continues on to the buy side. So I noticed that the best approach, so basically the approaches that I was coming up with were approaches that were geared, or rather tailored, to reduce the likelihood of you being hedged. Because once you are hedged, a problem that I wanted to explain would happen. So sorry about the planes, there's overhead helicopters, but essentially back to the video. The example that I was giving, once you are hedged, a problem I noticed happens. Hedging is a very weird approach, especially hedging using this approach is weird because I noticed that it compounds your losses. So what would happen at any given point in time is that once you've been hedged, your losses no longer reduce, they increase, unless you're lucky and you go into the best case scenario situation that I just explained. But if you are unlucky or the market keeps hedging you, so you'd find that you could, for instance, have a buy order here. You are triggered on the first sell, you close it. You're triggered on the second sell, you close it. But then if this happens for a period of time, your losses won't be reducing, they'll just be increasing. This is actually the main problem with this, because it essentially makes it an unviable or an inefficient approach for doing prop firms, because most prop firms tend to track your equity. And while tracking your equity, this is a problem with hedging, since hedging directly affects your equity and not really your balance. When it works with your balance, it actually gives you the impression that your balance is going higher or is increasing, but essentially at the end of the day, at any given point in time, your equity is your actual balance if you decided to close all your trades. So at a certain point in time, you'd find that you have a balance that's almost hitting the prop firm's target, like 10%, but then your equity is minus 8%, as you can see. So essentially, you're sitting on a very huge gap that you need to fill, because with every subsequent price the market moves against you, it continues to compound your losses. Additionally, something else that I noticed tends to happen is that once you are hedged, you essentially start working through your margin. It significantly affects your margin, since the margin that this trade is occupying can grow to the extent of actually capturing your whole margin, essentially blocking you from adding additional trades. And then at the end of the day, you can't essentially work yourself out of a hedge. Let me give an example. Assuming you bought at this level, and then the market dropped, you sold, you trimmed a bit, it continued dropping, you trimmed, and then you got to a point where you decided the market seems to be wanting to reverse, so you'll add another trade. So you buy. Once you buy, you've already offset the balance between these two trades. Assuming by now you're sitting at 0.1 lots each, and you think that you now have capacity to have a larger trade, so you don't even add all of it, you add like 0.4. Maybe you have a capacity of 1 lot, basically the maximum lot size you can trade on either direction. So you add a buy of 0.4, but then the market plays a trick on you, and then it heads lower and triggers your hedge of 0.4. If this was your whole margin, you've essentially blocked yourself. You've played yourself. Okay, let's assume that it triggers your sell and then heads higher into your buy, and you manage to close this buy. If you close this buy, you can technically close this trade fully and this one partially. Once you've closed them partially, you now remain with something like, let's assume 0.2 sell, and now you need to not only set a pending buy trade, but you need to balance the sell side of things, since it's now so you need to essentially add a buy trade that's smaller than that will essentially when you add them up, they'll balance out with this sell. So you add a buy trade. When that buy trade is added, let's assume it's 0.1, and then you become hedged again with a sell 0.1. As you can see, you keep getting hedged, and this could happen especially in ranges. It could happen in ranges whereby you keep getting hedged, and at the end of the day, you're just eating up your margin, and it essentially prevents you from proceeding and actually working through your losses. Of course, there are approaches you could use to work on this, like setting larger distances for when you're hedged, or using the structure. So that's an approach, but at the end of the day, it still results in the same problem, which is essentially compounding your losses. So at the end of the day, you need to find a solution that works with this strategy. And this is why I was saying you actually need a viable solution for working with hedging. And if now I can transition back to the charts, this is why, for anyone who's been emailing me, I haven't really been pushing for hedging, because it requires a certain level of tenacity and significant levels of luck to ensure that your strategy doesn't lead to you being hedged constantly. So that's essentially the update. In the past few months, I've been trying to build strategies or approaches that essentially limit, or rather reduce, the likelihood of me being hedged. And you can see some of them here. Like, I have something that shows me the structures, the breakpoints and such. These are strategies that I build myself, since I'm a programmer, so I tend to write them in my spare time. And I've been trying to come up with strategies, and once I have something solid, I'll definitely share it with you guys. It's it's the way in the recent past I've been recently I've been really engrossed in building. There's a platform that I'm building, a cloud trading platform called Trader Kit. That's actually been taking most of my time and working through all the communications with the beta testers for the strategy for the platform. So that's been taking most of my time, but I will be sharing more updates on my discoveries in as far as hedging is concerned. But for now, the thing I would say is that I am not hedging. Actually, there's a strategy that I'm actively trading. It's mostly based on structure and trading breakouts, placing stop losses reasonably, and yeah, alongside a bunch of other approaches to trading. The discoveries I made during hedging actually have been helpful. That's why I'd still recommend people to try hedging, because one thing that hedging gave me that no other strategy gave me is the ability to just sit back and watch the market and let it do what it wants. So that had been very beneficial to me, since while watching the markets during this moment, I started noticing certain repeating events and repeating patterns that I have started building a strategy on top of. And I have also been trying to take advantage of that on those moments in the market and test it across different pairs, currencies, and trading instruments. So that's essentially what I've been doing. Once I do have something solid, of course, I'll be sharing it. But for now, most of my time is being spent on actually working through the platform that I mentioned, TraderKit, and of course, experimenting with strategies. So for the time being, I definitely recommend. There's a video that I'll be adding in the description below where I discussed different approaches to improve hedging. Of course, I haven't tested out all of them, but they're definitely a good point to start from, since those approaches were based on my observations on how hedging actually works in the real world, and not these backtests that um, most YouTube traders tend to show. Like when you're working through a hedging strategy in the real world, anything can happen, and it it could hurt you in ways stop losses can't. Basically, it could harm you without proper guardrails. It could harm you in ways a normal strategy with a stop loss and a take profit couldn't. So I definitely recommend exercising a lot of caution and a lot of seriousness while determining the strategies you want uh, to work with in as far as hedging is concerned. But yeah, a final tip, something I noticed funny about hedging is that it works well um, with what are these called, mean reversion strategies. The best results that I've been getting are related to mean reversion, as opposed to what are these called, trend continuation strategies. So for instance, let me do Bollinger strategies, Bollinger bars, no, bands. Let me show you something, a bit of something related, let's say, to Bollinger bands. So hedging, I noticed, works well with when paired with strategies like mean reversion. Take a sell trade at this point here. Wait, where is this? So you would take a sell trade here, a sell, because the market has broken above, because mean reversion essentially makes the assumption that the market tends to revert to the mean. So at this point you'd take a sell and you'd place, let's say, your 20 pip stop loss or buy trade at that point. This would have worked out. But in other situations, for instance, if you are here and you placed your buy trade at this point when the market closed, no, it's actually here, closed outside the Bollinger Band, once you take your, we assume that this is your buy level. As you can see, in this situation it didn't work, but at your 20 point move, you've already sold. you sell, and you will have already closed the hedge at some point here. At this point where the market closed above the high, you're supposed to be selling. So if you wouldn't have already closed part of this, you would add another sell over here, and then you wait, and then when the market closed below, you could exit this sell and add a buy. As you can see, you take these profits and then you'd try selling here, and then you would hedge it. I believe you'd be hedged at about here, and then as you can see, you're working through the hedge using the Bollinger Band strategy, and that's essentially my point. Find strategies where hedging makes sense as opposed to trying to use trend continuation, because when you're using trend following with hedging, you would be selling, let's say, at this breakout. I'm not saying it's wrong, so you would have won this trade, but then whenever the market is ranging, it will be a bloodbath. Remember, you're eating up your margin and you're compounding your losses when hedging. So hedging works best, based on my observations, when you are, of course, trying to work with mean reversion. Otherwise, continue experimenting, continue trying out new approaches, and feel free to always email me. Actually, you can email me at hey@smallstepfx.com. I always respond to all emails that, whenever you contact me. It tends to be less convenient on my end to make videos than to communicate via messages and such, since I tend to be very busy. But at least before I set up my recording, make sure that it's quiet and start discussing stuff, and then once you finish, you start editing the videos. That's a lot of work, yet a query that you might have can be easily responded to via email. This is actually why I had asked initially whether I should just create a Discord group or a Telegram channel, whichever you guys prefer. I could create it, and then we could get together, discuss this stuff, and be in better sync than waiting for videos, which could come rarely, especially with work and such and other commitments getting a hold of me. But I really enjoy the support. Thank you for the support and everything. So yeah, I believe that's it. If you have any queries, please comment them down below or email me, or yeah, let's talk, discuss, and explore how to essentially succeed at this. Hedging isn't as easy as it tends to be advertised, but it's a very good strategy to get up and going, to get up and running in as far as, yeah, it's very easy to get up and running in as far as trading is concerned, and to be present in the market. That's actually the best advantage that I've gotten from hedging, because it forces you to be present. It forces you to actually be an active player in the market. You're constantly in a trade, you're constantly working through something. So it forces you to be present, and that presence essentially exposes you to a lot in the market, which is advantageous and helps you to get in sync with what the market tends to do. If you do it specifically with one pair, you can learn the ins and outs of that pair faster than anyone who's actually trying to backtest, because you're experiencing the whole motions of trading, from discovering what the market is doing now, trying to set your expectations on what would happen next, having those expectations met or broken at that point. It essentially keeps you in sync, and you learn a lot and you grow a lot. And yeah, that's actually why I'd recommend hedging. That's the only situation I'd recommend hedging, because once you get in sync with the market, that's actually when you then start growing, and then you start experimenting with other things because you'll be observing more and all that. Otherwise, feel free to email me, contact me if you have any queries. Follow me on other platforms like Twitter and other points, since I tend to share more on those platforms compared to video. But yeah, tell me actually if you also like this format, because I could have moments where I make a video that doesn't require a lot of editing, and then it's easier for me to actually make more of those as opposed to highly edited and scripted videos, which I've been doing before. But otherwise, thank you for the support. Please don't forget to like, share, and subscribe to the channel, and see you next time. Cheers.